Wondering where undervalued stocks are in this market? Looking for a cheap, high-quality stock paying safe, growing dividends? Want a market-beating yield and inflation-beating dividend growth? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a biopharmaceutical company providing treatments for life-threatening diseases. There are a lot of expenses out there that are rather discretionary in nature, but one expense that isn't discretionary, healthcare. If you have a life-threatening disease, you're going to do whatever it takes to get treatment for that. And with the world growing older, bigger, and richer, demand for and access to quality medicine is only sure to rise. That means growing profits and dividends for this company. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Gilead Sciences Inc., which appear to be trading at a significant discount today. Gilead Sciences Inc., stock ticker GILD, is a biopharmaceutical company that develops and markets therapies to treat a variety of life-threatening diseases. Founded in 1987, Gilead is now a $84 billion by market cap global drug giant that employs more than 13,000 people. The company's three primary disease areas are viral diseases, inflammatory diseases, and oncology. Gilead specifically focuses on HIV and hepatitis B and C. Their HIV franchise accounted for approximately 70% of fiscal year 2020 sales. Biktarvy, which treats HIV, is their most important drug, making up about 29% of total fiscal year 2020 sales. The US accounted for approximately 74% of fiscal year 2020 sales geographically. The rationale for investing in a major biopharmaceutical company such as Gilead is always straightforward. Simply put, healthcare is a non-discretionary expense that has constant demand. If someone can afford top-flight healthcare, they will do whatever they can to access it. With the world growing bigger, older, and wealthier, demand for and access to high-quality healthcare products such as life-saving drugs is only going to rise. That bodes well for a company like Gilead to continue growing its profit and dividends over the long run. As it sits, Gilead has already increased its dividend for 7 consecutive years, with a 3-year dividend growth rate of 9.4% coming on top of the stock's current yield of 4.2%. There's an appealing combination of yield and growth here. That market-beating yield, by the way, is 70 basis points higher than the stock's own 5-year average yield, and the dividend is protected by a low payout ratio of 37.9% based on trailing 12 months adjusted earnings per share. The dividend metrics are surprisingly strong for Gilead. You want a high yield, fairly high dividend growth rate, and low payout ratio? Check, check, and check. The only knock against them is that more recent dividend raises have been smaller. Dividend growth has definitely decelerated with the most recent dividend increase coming in at less than 5%. Looking at business growth, Gilead grew its revenue from $8.385 billion in fiscal year 2011 to $24.689 billion in fiscal year 2020. That's a compound annual growth rate of 12.75%. While this is impressive, it's important to keep in mind that revenue peaked in fiscal year 2015 at over $32 billion for that year. Gilead is in some ways a victim of its own success. The revolutionary HCV cure eliminated the need for treatments. Nonetheless, the long-term picture is still excellent. Earnings per share increased from $1.77 to $7.09 adjusted over this period, which is a compound annual growth rate of 16.67%. Again, we have an outstanding 10-year result that has to be viewed within the context of mid-decade explosive growth that has recently cooled down rather significantly. Share buybacks drove a lot of excess bottom line growth. The outstanding share count is down by 20% over the last decade. Looking forward, CFRA is projecting that Gilead will compound its earnings per share at an annual rate of 6% over the next 3 years. This might seem disappointing in light of what the company has historically been able to do, but I think it's a reasonable estimation of the near-term growth potential when you factor in more recent results. A bet on Gilead is largely a bet on their HIV franchise, which is the linchpin of the business. CFRA sees considerable considerable growth ahead for their key HIV Biktarvy drug, offset by the loss of exclusivity in other HIV drugs such as Atripla and Truvada. The company's pipeline is healthy. It includes a total of 82 different compounds. In addition, the $21 billion acquisition of Immunomedics could pay off handsomely. Key cancer drug Trodelvy received FDA approval in April 2020, and this drug is expected to do $3.5 billion in annual sales by 2026. Gilead is also seeing a temporary boost from COVID-19 treatment, Veklury, branded remdesivir. A near-term 6% earnings per share growth rate is likely to lead to a similar or better near-term dividend growth rate, especially after factoring in the low payout ratio. And that's appealing when you pair that kind of growth with a starting yield of over 4%. Moving over to the balance sheet, they have a good financial position. There has been some deterioration of the balance sheet in recent years as Gilead has sought out growth through acquisitions, but their position is not weak. The long-term debt to equity ratio of 1.72 looks high, but I see that as a function of low common equity rather than a high debt load. Meanwhile, the interest coverage ratio is not applicable for fiscal year 2020 due to unusually volatile GAAP earnings. However, we can see that the interest coverage ratio for fiscal year 2019 was over 6, indicating no issues with debt servicing. Their interest expense has not materially increased year over year. Robust profitability is a bright spot for the business. Over the last 5 years, the firm has averaged annual net margin of 23.06% and annual return on equity of 33.09%. Fundamentally, Gilead is sound, bordering on outstanding across the board. However, a reduction in demand for HCV treatment vis-a-vis their development of a cure, combined with very high expectations for the stock about 5 years ago, have created the conditions for poor stock performance over the last few years. But with expectations now low and revenue back on the upswing, there could be a long-term opportunity here. And the company does benefit from durable competitive advantages that include economies of scale, IP, patents, R&D, inelastic demand for products, and an established relationship with their partners. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The slowing HCV market and incoming generics for HIV threaten Gilead's sales base. There's integration risk with Immunomedics, as well as pressure on Trodelvy to perform. And there's always the risk that the pipeline doesn't produce enough blockbusters in order to overcome slowing sales from older drugs. Overall, I view these risks as manageable. That's particularly true when they're lined up against the valuation, which is compelling. The stock is trading hands for a price-to-earnings ratio of 9 based on adjusted trailing 12 months earnings per share. That's a very low earnings multiple by any standard, even for a business that has suffered some disappointments in recent years. However, using adjusted earnings per share does cloud things. On the other hand, the stock's price-to-sales ratio of 3.3 is markedly below its own 5-year average of 3.8. And the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate to account for the higher yield and a long-term dividend growth rate of 5%. I'm modeling in low expectations. It's not a high bar for the business to clear. This dividend growth rate is lower than both the demonstrated long-term earnings per share growth rate and the dividend growth rate. I'm also coming in below CFRA's near-term earnings per share growth forecast. With a low payout ratio and higher near-term earnings per share growth expected to materialize, I think this is a rational, if slightly cautious calculation. The dividend discount model analysis gives me a fair value of $74.55. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Gilead as a 4-star stock with a fair value estimate of $81. CFRA rates Gilead as a 3-star hold with a 12-month target price of $66. I came out right in the middle this time. Averaging the three numbers out gives us a final valuation of $73.85, which would indicate the stock is possibly 10% undervalued. Here's the bottom line, guys. Gilead Sciences Inc. is a high-quality biopharmaceutical firm benefiting from the demographic tide lifting all boats. Growth is back on the upswing and expectations are low. With a market-beating 4% plus yield, inflation-beating dividend growth, a low payout ratio, and the potential that shares are 10% undervalued, this is an attractive long-term idea in an otherwise expensive stock market. And now for a special news announcement. Viatris Inc., stock ticker VTRS, just put out a stellar Q1 report, sending the stock soaring. In addition, they declared their first quarterly dividend as an independent company at 11 cents per share. We highlighted Pfizer Inc., stock ticker PFE, as a great long-term opportunity last year when the stock was in the low $30. And we specifically noted the Viatris spinoff as a catalyst and additional source of long-term income and total return. That's turning out to be very true. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.